a big question right now is, are we in fact in a currency war? Do you see China's allowance of the weakening of the yuan? Do you think that this is just the beginning of that there's an actual concerted effort to further weaken the yuan?
Here's the irony, Melissa. For a very long time, for over a decade and a half, the US and the rest of the world community has been telling China to let its currency's value be determined by market forces. And now that the Chinese are doing it, of course, it works to their favor. Now they're being blamed by the Trump administration for doing exactly that, which is letting markets push down the value of the currency. What's happening is basically that the Chinese economy is cooling off. There are concerns that the tariffs are going to hurt the Chinese growth. And all of that is putting downward pressure on the renminbi. Until a week or so ago, the Chinese central bank had been resisting this downward pressure because they feared exactly this sort of reaction from the Trump administration. So this is largely market-driven depreciation pressures, but the People's Bank of China, the Chinese central bank, is clearly willing to let this happen. But it is evoking a very strong response from the Trump administration, which could certainly turn this into a more open currency war.
They are allowing this to happen, Eswar, the PBOC, but also in a statement last week, it made it sound like the PBOC wanted to diverge in its path from other central banks around the world in terms of easy monetary policy. It almost sounded like they were ruling out any sort of a rate cut to help the Chinese economy, which would further put pressure on the yuan, I would imagine. So do you really think that do you think there's a floor there? Because they seem to be telegraphing that they don't want to be like the other central banks around the world, which are, in effect, allowing their currencies to weaken.
Yeah, there are two things to note here. First of all, currency depreciation is a slightly risky gambit if that's what the Chinese are counting on to resist the tariff measures imposed by the Trump administration. We saw in 2014, 2015, and even in 2016, this cycle of currency depreciation of capital outflows that became very difficult for the central bank to manage. So they don't want that to happen. So I think they're sending a signal that they're willing to allow some market-driven depreciation, but not very substantial devaluation. In terms of monetary policy, China still has a lot of room. In fact, the M2 growth numbers that came in just about a day ago show that M2 is growing at about 8%, which is less than nominal GDP growth. So, in fact, if they want to ease up on monetary policy through either rate cuts or through more credit expansion, they certainly have a lot of room. They're holding it in reserve.
Eswar, I wonder, we know the administration wants the dollar weaker, but do you think they are overestimating the degree to which the dollar reacts solely to rates?
The dollar certainly reacts very significantly to rates, but remember, the dollar still remains the world's dominant safe haven currency, and all the talk about currency wars and all the volatility it implies in foreign exchange markets and in capital flows tends to make investors a little nervous, especially about some emerging markets that are very exposed in terms of foreign currency debt. If the Trump administration follows through on its move with tariff threats against not just China, but against other major trading partners, including Canada, Mexico, Japan, Europe, and so on, this creates a lot of uncertainty. And at times of uncertainty, investors look for safety. And typically the place they come to for safety is the US dollar. So you could have the paradoxical effect of the Trump administration threatening to undertake its own steps in the currency wars, actually ending up firming up the dollar rather than letting it weaken.
Eswar, can you extrapolate the impact of a potential currency war on other countries around the world for us? I mean, we think about a U.S.-China currency war, but the ripple effects really are going to hit yuan bloc countries, those countries that do a lot of trading with China, for instance, which will be effectively forced to devalue their currency as well.
That's true. There are certain emerging market central banks like India and Thailand that have already taken defensive actions in order to cut rates more than had been expected by markets in order to protect their economies from any of this collateral damage of currency wars. But among emerging markets, it's a mixed group. There are some countries with large current account deficits and a lot of foreign currency debt that are worried about letting their currencies depreciate. But certainly there are many emerging market economies and also many advanced economies around the world, including Europe, Japan, that are counting on currency depreciation in order to boost their economies. So when they speak about easy monetary policy, one of the very important channels for them is weaker currencies. Now, the problem is that not everybody can depreciate at the same time. So what might happen as a result of so many central banks trying to cheapen their currencies again is a lot more volatility. And ultimately, if you think about what that effect could be on the US dollar, it would be strengthening the US dollar because every other currency might end up weakening somewhat against the dollar.
And that's basically what's happening now.
Indeed, we are seeing signs of that already. So the Trump administration's attempt to talk down the dollar, especially with aggressive talk and aggressive measures to get the Fed to cut rates, may actually backfire on it by causing the dollar to strengthen. And that's certainly not going to help the U.S. trade deficit either with China or with the rest of the world. So this is hardly going to help U.S. growth in any way.